got that right. Michael, welcome to you.
Thanks. Hi. Happy to be here.
A lot of people don't have a lot of conviction on Home Depot right now because we still see the housing market overall in kind of this frozen state.
Yeah, well, we like it for 2025 because we do think that rates are going to come down, and Home Depot does well in that kind of environment. We think housing is at least bouncing along the bottoms and should get better. Well, we also like it in the short term. One of our calls is that retail typically does not do well this time of the year. In fact, in 10 of the last 14 years, the XRT has underperformed the market from Black Friday to year end. There's just too much risk this time of year. We call it the silly season. But there are some names that actually do well this time of year in our group, and it's the ones that have the least holiday exposure. That might sound counterintuitive, but in some ways it makes sense. The less risk you have, the better the stock typically does this time of the year. And so that's Home Depot and Lowe's, that's the auto parts retailers, and that's Tractor Supply as names that hold up well this time of the year.
See, that's so brilliant. That makes perfect sense to me, and I'm so glad that you pointed that out. Of course, there's headline risk. All of us turn into mini retail analysts, and every time we get the MasterCard or the thing, oh, they're only up 3.1%. What could this be? Every time, and so it just creates this. Now, maybe volatility is good for certain traders, but for investors, it must drive them crazy. Listen, you did some channel checks this weekend. I did a lot of channel checks at the mall last week. What were your big takeaways?
Yeah, and by the way, that's exactly why we call it the silly season, because the analysts get on, they say, oh, I went to Best Buy this weekend. It looked a little bit less crowded than last year at the one store that I usually go to, and all of a sudden everybody panics. So, again, the less risk you have this holiday season, the better the stock typically does. That being said, yeah, we did go to Best Buy, and actually the traffic was heavy. Now, Best Buy is always the most crowded store that we go to on Black Friday. Everyone loves consumer electronics, big destination this time of year. So not surprisingly, they were crowded. Walmart actually was pretty crowded as well, particularly, again, the consumer electronics area in the toys area in Walmart looked well shopped as well.
I didn't realize that Build-A-Bear was public. I went in there for the first time the other day, and I was a little underwhelmed.
Well, not only is it public, it's up 65% year to date. It's been a really good stock, so we think it's worth taking a look at. We think it's underfollowed, underappreciated. Despite the fact that the stock's been up 65%, it's still a low valuation. In other words, most of that year-to-date stock performance has come from increased earnings rather than multiple expansion, so a name worth looking at.
All right, so give me who's going to be the next Build-A-Bear going into 2025?
Another smaller cap name that we like is Lovesac. That stock's up about 45%. They'll do an analyst day in December 17th, I believe, in New York City. They're going to unveil their recliner chair. More products coming next year. We think that's another smaller cap name to own. So that's among our favorite small cap names. Again, on the big cap side, Home Depot, a top idea. And Dick's, we've called Dick's a best idea now 2 years in a row. In both years, it's outperformed. Yet it's still only 14 times earnings, as one of the previous guests said that the market's trading at about 28 times. Dick's has been a really strong stock and still only 14 times earnings. So we think there's a lot of room to go on that one as well.
So surprising. Michael, this is why we love talking with you. Thanks for coming on. We appreciate it.